First of all, good afternoon, everyone, and Ramadan Kareem for everyone. I would like first to thank you very much for attending our first webinar in English language. And today I'm very pleased and proud to have Dr. Mohammed El-Gammal, the Associate Professor of Finance in Qatar University. And Dr. Mohammed, by the way, is awarded the Excellence Award in Research from the university. Dr. Mohammed today will cover financial analysis. I give you a presentation about financial analysis, fundamental analysis and technical analysis. He will give you all the details later. But I have two important points I need to make before we move to Dr. Mohammed. First, that this is, as I mentioned, the first webinar in the English language. And next week we will have two other webinars in English language. One on fundamental analysis, we'll focus on fundamental analysis, and we will be very happy to have Dr. Bana Abu Zayed, Associate Professor of Banking and Finance in Qatar University as well. It will be the same time, 1:30. And this will be on Sunday. If you want to register, please go and visit our website and register for this webinar. Also, the other one will be on the 13th of May, Wednesday, 13th of May, same time. It will be Introduction to Trading on QSE. The second point, as I mentioned earlier, please, if you have any question, put it on the question and answers. Better than chat, because on the question and answer tab, we can follow up the questions better than the chatting. So please put your questions, all your questions. Now, I am very proud to move to Dr. Mohammed El-Gammal, and I would like to thank him very much in advance. This is the second time to be with us, Dr. Mohammed. First time it was on Monday, last Monday in Arabic session. Today it is in English session, and I am sure that everyone here will benefit a lot from your knowledge and experience, Dr. Mohammed.
Thank you.
Please.
Thank you, Mr. Samer, for inviting me to be here. It's my pleasure to be under the umbrella of Qatar Stock Exchange. I would like to thank you, and thank you also, Mr. Rashid Al-Mansouri. I will start directly to save your time. Ramadan Kareem for everyone. I think this is a beginner session. That means if you expect to be a professional trader after this session, I'm sorry, you cannot be. You have to attend many sessions to be a professional trader. What is the aim of our presentation today, or our session today? The main aim of our session today is just to give you the beginning and background information about financial analysis. The financial analysis actually is a matter of language. You need to learn this language. First of all, you need to be able to understand and to read the financial statement and the financial information. So my target today is to introduce to you a way to read the financial statements, to be able to understand numbers and figures. Don't worry, I will not ask you to calculate them. You don't need to know how to calculate them, but at least you need to understand what is the meaning of these financial figures. What is the meaning of this financial information? How much the value of the stock? Is it good time to buy this stock today? If the price of the stock in the stock market is fair enough, is it overvalued? It is undervalued? How can I know this is a good company? How can I know it's a proper place to invest my money? This is actually what I'm going to do today. Today, I will just introduce for you the alphabetical of financial analysis. First of all, what we are going to cover today is definition of financial analysis, the two main categories of financial analysis tools, and how to read financial statements. Let's start first from the financial analysis. What is a financial analysis? Why I need to know about financial analysis? Is it important, and why it is important? Actually, the financial analysis is a methodology to understand the firm value. How can we evaluate the firm? How can we evaluate the stock price? So every tool you are using to evaluate stock price and the firm value can be considered as a financial analysis. However, the financial analysis can be categorized to two main categories: fundamental analysis and technical analysis. What is the difference between fundamental analysis and technical analysis? The fundamental analysis is related to the firm itself. The fundamental analysis assumes that the stock price will be affected by the performance of the firm. That's mean the profitability of the firm, liquidity of the firm, the operation of the firm. So if there is any enhancement in the firm performance, this will be reflected in the stock price. And people calculate the stock price by calculating the firm value itself. On the other side, the technical analysis assume that the value of the stock or the stock price will be affected by the demand and supply and by the previous movement in the stock prices. So the stock prices in the past will affect the stock prices in the future. So for example, if we look to the past and understand the trends, how the stock prices move over a long time period or a short time period even, and we assume that the history will reflect itself, so we should expect how the stock price will be and how much the stock price should worth. Of course, there is a big controversial debate between the opponents of both financial analysis, fundamental analysis and technical analysis. However, from my point of view, if you would like to find an accurate estimation for the stock prices, you need to be aware by the two techniques. Because I believe that the financial or the fundamental analysis can help you to determine which stock, which firm you have to invest your money in. So the fundamental analysis tell you what stock you can invest in, where the technical analysis inform you when you have to invest. So you can do the fundamental analysis. At the end of the fundamental analysis, you will learn which company is good enough to put your money in. This company, for example, company X has a very good profitability. The profits increase over the time. Their leverage ratio is fine. They don't have a lot of debt. They always have a very good liquidity. Their relationship and sales relationship with customers and sales are very good. So this is a good company. I decide to buy in this company based on the fundamental analysis. And the technical analysis will tell me what is a good time to buy the stock. Is it today? Should I wait until Ramadan finish? Or the prices will go up after Ramadan because people after Ramadan come back very active to the market? Should I buy before Ramadan? Because people in Ramadan doesn't trade a lot, so the price just in the first 5-6 days of Ramadan will go down, will drop. So it's a good opportunity to do it. So the technical analysis can be complementary to the fundamental analysis. Let's discuss some differences between fundamental analysis and technical analysis. The fundamental analysis can be done by using two different approaches: bottom-up approach or top-down approach. What's the difference between bottom-up approach and top-down approach? The bottom-up approach is just start from the bottom. You determine a firm and you decide to study everything about this firm. It's focus about the firm or company, financial products, market share, other corporate finance related factors. So you start from the firm, and after that you may, if you are interested to this firm, if you find this firm is fine, I'm happy with it. Let's compare this firm with other firms in the same sector. So I will go up to the sector to look to the performance of the sector. And after that, let's compare this firm among this sector with the economy as a whole, the country economy or whatever. The other approach starts from top to down, started from the macroeconomic factors. So you look to the macroeconomic factors. We have many macroeconomic factors, and macroeconomic factors is a kind of factors which affect all firms, all industries, maybe in different ways, but all of them will be affected in some way. Like, for example, Corona, like, for example, financial crisis, interest rate, inflation, oil prices. All of these factors can be considered as state factors or macroeconomic factors. So we start by studying macroeconomic factors and start by asking ourselves, which is a good market? In this Corona, is it good market now to invest in United States, for example? Maybe the prices now is very low. Is it good opportunity? Or maybe China, because it is promising now. They already finished their crisis. And after that, after considering many macroeconomic factors, we'll go to look to the sector. Which sector? Yes, I decided to invest my money in Qatar because it is more resilient compared to developing countries. The market here is not volatile too much. So I'm happy to invest my money in Qatar. So which sector? Maybe healthcare. Let's see every sectors and how is every sectors is working now, and what is the new news I have about their prospective projects. After that, I will go to the company. If I decide to do my investment in health sector, for example, okay, which company in health sector is better? This is how the fundamental analysis work. The technical analysis, again, as I mentioned before, the technical analysis is a study of stocks' historical market prices and the volume and the trends. And actually, we assume that the history can repeat itself. The technical analysis has three major assumptions. First, market discount everything. Stock market price reflects all factors which affect the fair value, including fundamental factors. So we don't need to be worried about fundamental because the original price already captures the fundamental factors. The second assumption, prices moves in trend. The third assumption, which is very important, history tends to repeat itself. In other words, different market players tend to have the same psychological response to similar market events over time, fear and excitement. So the technical analysis use chart for the past history and patterns to study emotions, fear and excitement, and consequent market movement. So if I assume that usually in the summer the stock price is going down in Qatar, if I watch this trend for previous year, so I will assume next summer the stock prices will go down. So what happens usually? Because people know about my assumption, people know about the technical analysis charts and trend, they follow the trend. Because everyone is afraid that the prices will go down in the summer because people will be outside of the country. Every year the price is going down. So next year the price should go down. I will not go to buy any stocks. In this case, actually, there is no demand. And maybe I will go to sell all my stocks to liquidate my portfolio. In this case, actually, there will be a lot of supply. So the prices really will go down because of our action. So actually, sometimes we act in a way, makes the technical analysis right, not the technical analysis originally right. Anyway, let's start by the financial statement. How can we read the financial statement? First of all, why the firm has to do a financial statement? Every firm needs to do financial statement to summarize the financial information of the year. However, companies or firms who are listed in the stock market, corporations, is owned by the shareholders. You are the owner of the company. If you have one stock, you are the owner of this company. And if you are the owner, you are able to make decisions. You are able to manage this company through agents. Who are the agents? They are the board of directors. Every stockholder has the right to elect board of director. If you have one share, that means you have one vote. By the way, share is stock, stock is share. So I will use the two words. So just I will try to not to confuse you. So in this case, somebody else will run our company on behalf of us. We are shareholders. Maybe a company like Isdan has more than 3 million shares. So maybe we have 200,000 or 300,000 shareholders. They cannot manage the company by themselves. They have to elect board of directors. And the board of directors need every year in the AGM, the annual general meeting of the shareholders, to present the financial performance of the company. How can they present the financial performance of the company? Through the financial statement. This financial statement is required by the law. And also, this financial statement should be audited. That means external auditors should audit the financial statement to be sure that the financial information in this statement are right and has been prepared in a proper accounting way. So what is the most important financial statements? And what is the difference between financial statements and financial reports? The most important financial statements: balance sheet, income statement, cash flow statement, change in equity statement. What's the difference between these statements? The balance sheet is like a snapshot. It's capturing the financial position of the company in the end of the year. That's why we usually find a title of the financial statement or the balance sheet is balance sheet of company X in 31st of December. That means in this time point, this is a photo. I take a photo for all the assets and obligations of the company. What the company owing and what the company owe toward the others. Liabilities, assets. The income statement is just an income statement. It just tells you what is the company revenues was and how much expenses they pay to make these revenues and what is the net income of the company. The cash flow statement focus more about cash in and out. The change in equity statement focus only on the equity rights and the equity change, the capital, retained earnings, surplus, and such things. Disclosures notes, which is actually part of the financial reports, is contain the narrative disclosure. It explains how the numbers happened, what is the different accounting policies, what about the future, what kind of projects the company decide to do. There are many narrative disclosures and they are very important because they will tell you more about the company, more than the numbers. It tells you about the company plans for the future, the different type of risks you may face or the company may face and run their business. So it tells you more information. All this information should affect our analysis. Let's go more detail to the financial statements. This is our first financial statement today. What is called? Again, it is balance sheet. You can see the balance sheet, the left side is the assets and the right side is liabilities. Nowadays, usually the balance sheet has a long balance sheet. So the assets in the up part and the liabilities and owners' equity in the down part. So again, what is the balance sheet? As I mentioned, it's just a snapshot of the firm, the assets and liabilities. But what is the assets actually? The assets in the left hand is it your belongings. It is a firm, what the firm own, the firm positions. And liabilities, it's actually what the firm have to pay. It is what the firm owe to others. If we look to the assets, the total assets in any point of time should be equal to the total liabilities and owner equities. I would like you to think about liabilities and owner equity as a source of finance. The firm to be able to work, they need money. And usually the firm bring money from either equity, that's mean issue stocks, or from liabilities, taking loans. This is the source of finance. Why we are taking this source of finance? To invest them. So the assets is your investment, is your actually use of money. So in any point of time, your total assets should be equal to the liabilities plus owner equity. Because if you have a source of money, you need to use this money. So that's why our balance sheet identity, you can see it here, assets equal liabilities plus stockholder equity. So what kind of assets we have? We have three different types of assets: current assets, fixed assets, and we have also non or intangible assets. Let's start first by the current assets. What is the current assets? The current assets are liquid assets. What I mean by liquid? What does liquidity mean? Liquidity is how fast you can transfer your assets to cash without significant loss. So liquidity is the ease to transfer your assets to cash without significant loss. In another word, do you have enough money, or do you have enough assets to be able to cover your operating cycle? Every firm has an operating cycle, and maybe your cash flow will come in the end of operating cycle. Remember, every company has to buy some material, doing some work, selling the product, collecting the money. The time between buying the material until collecting the money, we call this time operating cycle. You need to be able in this time frame to find a way to pay salaries, to pay electricity, rent, other expenses, maybe even the price of the raw material itself. So you need to have some money with you. If you keep this money in cash, this will not make a sense because the cash will not bring any profitability. So you need to keep some assets which may bring some profitability. We call these assets actually current assets because actually the balance of these assets, it changes over the time. They increase and decrease over the short time. Their life cycle is less than 1 year. For example, cash, of course, cash has 100% liquidity because it's already liquid. Receivables, what is the receivables? When you are selling your products to the customers, most of the firms, especially manufacturing firms, have these sales and they will collect the money later. We don't have cash sales, or most of our sales are not cash. So we have this receivables accounts. So the receivable accounts is our money, but it is in the position of our customer. They have to pay us this money in the future. We have also inventory, and the inventory, as you know, it's our money, but the inventory is less liquid compared to the cash and receivables, because if you try to sell the inventory very quick, you have to reduce its price, and maybe the value of inventory change over the time because the age, new products appears, maybe lose its validity, expire date, whatever. There are many reasons which may affect the value of the inventory. Anyway, the second type of assets is fixed assets. And the fixed assets actually is the assets which can be used more than 1 year. Actually, you can reuse it many times in the production process. For example, your car. You are keeping your car for more than 1 year. And you can use your car to go from where to another place, and you can repeat this thing many times. This fixed assets include many items like land, buildings, machines, tools, anything which has a life more than 1 year and which can be used in the production process more than one time, more than once, can be considered as a fixed assets. However, we need to calculate something called depreciation. What is the depreciation? It's just an expenses to reduce the value of the fixed assets every year. I will give you a simple example for this. Let's assume you buy a car for 100,000 riyal, and you would like to sell this car to me after 1 year. And you asked me for 100,000 riyal. Of course, I will refuse. I will tell you, no, you already has consumed your car. You already has depreciated your car. Your car doesn't worth anymore 100,000 because you already has used it, and it is not as the new car anymore. So you need to calculate depreciation every year. How can I calculate depreciation? There are many ways to calculate depreciations. One simple way, just by dividing the price of your fixed asset over the number of years. Number of years, what I mean by number of years, that's mean the life of the asset. And for example, if I assume that I will use the car for 5 years, and in the end of the 5 years, the value of the car will be 0, that means I cannot sell the car after the 5 years. So the depreciation will be 100,000 minus 0, which is the salvage value, the value of the car in the end of the life cycle, over 5, which is the life cycle or number of years or production life. 100,000 over 5, that means 20,000. That means actually I need to reduce the value of my car every year by 20,000. That's why we minus the accumulated depreciation. That means the value of my car in the end of the first year will be 100,000 minus 20,000 depreciation. So my net value of the car is 80,000. In the second year, it will be 100,000 minus 20 for the first year and minus 20 for second year. That means minus 40 actually. So the value of the car will be 60,000 and so on. The third type of assets is intangible assets, and this kind of assets has a value. Also, they don't have a physical appearance. For example, goodwill, patent, and the trademarks. Very simple. If you are buying a company which has a good name, you have to pay for this name. The name itself has a value. Imagine actually you are going to buy a factory which produce, let's say, for example, perfume, very famous perfume. Everyone likes this perfume. Everyone would like to buy this perfume. You have to pay for this trademark. It's a trademark. Yeah, you need to pay for it. This is actually the asset side. If I would like to move to the liabilities and owner equity sides, let's start first by the liabilities. Liabilities, it's a money of the others. You borrow this money to invest in your company. So the liabilities is not your money. You are liable to repay this money in the future for others. And we have two different types of liabilities: short-term liabilities and long-term liabilities. The short-term liabilities, which we called current liabilities, is the money which is due in a period less than 1 year. the money which is due in a period less than 1 year. This include payable notes or payable accounts. And what is the payable notes and payable accounts? The payable notes and payable accounts, actually technically it's covers something you owe to your suppliers. You buy material from the supplier and you didn't pay, and they record this in their accounts. We call this actually payable accounts. But if you give them checks or any papers, commercial papers, we call this actually payable notes. Also, current assets, current liabilities will include something called short-term loans, which loans have a maturity less than 1 year. That means you have to repay these loans in a time period less than 1 year. The long-term liabilities is long-term loans and bonds. Long-term loans is loans has a life or maturity date more than 1 year. You are going to the bank, take a loan for 2 or 3 years. What is the bonds? Bonds is very similar to long-term loans. The main difference, you are taking long-term loans from banks and financial institutions, while bonds, you are borrowing from investors through the stock market. So imagine company X would like to borrow $100 million. Rather than taking the loan from the bank, they are going to issue bonds in London Stock Exchange, for example. Every bond has a value of $1,000 at interest rate 5%. So they will divide it on $100 million over $1,000. That means they need to sell 100,000 pounds. If I buy one bond at $1,000, interest rate 5% semi-annual, for example, that means they have to pay for me every 6 months 2.5%. If it is 5%, that means $225 every month as interest. And in the end of the life of this bond, let's say 5 years or whatever, I will take my money back. So what happens when you buy bond? You actually lending the company. What happens when you buy stock? You actually investing in the company. So if you invest your money in stocks, you are owner. You can decide which board of directors can manage the company. And you may make a very huge amount of profits, or you may have loss. But if you buy bond, you have a fixed income because you will get only the interest rate. It does not matter how much the firm will make, how much profit the firm will affect, because in the end of the day, you will get only a fixed interest rate, not more. After that, so we have the first part, which is current liabilities, the second part, long-term liabilities, and the third part, which is owner's equity. The owner equities include the paid up capital, that means the amount of capital, for example, the stock nominal price multiplied by the number of shares, reserves, and retained earnings. All of this actually are the money of the shareholders. All of this are the total owner, the equity. The capital, we understand by the capital. What is the reserves? The reserves is money has been held by the company for a specific purpose. Maybe because we expect some loss in the future, we expect a change in the oil price, so we keep this money to face emergency. Retained earnings. What does the retained earnings mean? You are making profits. You decide, I will not distribute these profits to the stockholders. Why? Because we are going to invest this again inside the company. So the retained earnings is a part of the company earnings which will not be distributed to the stockholder, because the company will reinvest this money inside the company. Usually, the firm decide to return money if they have a very good project in the futures. And usually the stockholders will discuss this issue in the AGM, and they usually approve it because they know that this retained earnings will increase their wealth in the future. Because if the company make good projects, that's mean more money in the future. The second financial statement is the income statement. This is a very simple one, actually. The income statement, as I mentioned before, is just a statement to tell you how much our revenues was and how much our expenses was in a specific period of time, from to. So it's like a video, tell you the story. We buy material. We have direct and indirect cost. We sell this and we make this profit. Usually we start the income statement by the sales or turnover. We take out from this the sales return or any discount or whatever. So we have the net sales. After that, we take out something called cost of goods sold. That means your direct cost of goods sold. This includes your material, raw material, maybe industrial labor, all this type of cost. And the difference between net sales and COGS will be actually gross profit. And usually we called it EBITDA. What this means actually? Earning before interest and tax depreciation. After that, we'll take out from this gross profit general and admin expenses, which is indirect cost. We'll take out the depreciation expenses. So the depreciation will appear twice. Once in the balance sheet as accumulated, not only for this year, but also for the previous years. And another time in the income statement, but only for this year. If we take out the depreciation expenses and general admin expenses from the gross profit, we will have something called net operating profit. And the net operating profit, usually we call it EBIT, which is earning before interest and tax. After that, we should calculate the interest. And as I mentioned, the interest is the interest rate multiplied by the outstanding loans. And we'll take out the interest, so we'll have net profit before tax. And you need now to pay tax. Of course, if the company is 100% owned by Qataris, you will not pay tax inside Qatar. But before paying tax, you need to add other income. That means income coming from other sources not related to the primary activity of the firm. For example, interest revenue, capital gain, whatever. So you'll have something called taxable net profit. That means the profit which you have to pay tax on it. You will take out the tax and you will have net income. And the net income, actually, this net income is your earnings. This is the amount of money which you can distribute if you would like to distribute. And you have to decide how much earnings you will keep inside the firm, how much dividends you are going to make. So you have to decide the amount of retained earnings and the amount of dividends. Who decides this? Board of directors, but they need to take the approval of stockholders in the AGM. This is the income statement in general. I will give you, I will answer, now I'll give you a break for 2 minutes or 3 minutes. I will take some questions and I will answer some questions this minute. And after that, we can continue with the financial analysis tool. So let's see the questions we have. I have a last question. We're looking at a trend. Is monthly, yearly, short better? It's up to you. If you are focused about short-term investment, you have to use short-term trends. If I would like to do, some investors actually focus on day trend, not even monthly or year. So it's up to you. What is your... Mr. Thamir would like to add something about this answer, I think.
Yes.
Yeah.
When looking at trends, it depends on your strategy of trading. Some people are trade in like long-term strategies, and some people like speculators, they are day trading, yani trade on a daily basis. So you'll find some technical analysts, when they look at trends, they only look at the trends during the trading session, and others are looking at a longer term trends. So it depends on your trading strategy, but of course, the more the period that you cover in a trend, the more accurate the decision or the analysis that you can make. So it's better always to look at longer term trends rather than daily trends. But as I said, if you are a daily trader, maybe daily trends will be helpful for you in this case.
Thank you, Mr. Samer. This is a very accurate answer. I think most of the analysts usually doing many dimension trends. So usually they compare between long-term and short-term trends. So and make their decision based on their investment strategy, as mentioned, as Mr. Samer mentioned. We have question from Mr. Aisa: how to calculate the intrinsic value of the company to know what is the exact buy price with discount? Okay, this is a nice question. I think it's too early question, but I will answer it. The fair value of the company can be calculated using many models. All these models has a very simple idea. We need to discount the value of expected cash flow of this company using a discount rate reflect the risk of the business of this company and the market risk. So what does this mean actually? You are going to invest in company Y. Let's say that I would like to invest in Y company. How much cash flow I expected this company will give us in the future? You can measure the cash flow by the dividends. You can measure the cash flow by the expected sales. There are many models, as I mentioned before. And you have to discount this cash flow. What do you mean by discount this cash flow? If the company will pay you 5 riyal after 1 year, this 5 riyal, the value of the 5 riyal today is not 5 riyal, because the 5 riyal after 1 year has the value today is 4 riyal or whatever, based on what? Based on the discount rate. And the discount rate should reflect the risk of the company, business risk, market risk. I think we need to allocate, I had a discussion with Dr. Samer, we need to allocate one session for calculating and different models we use to calculate stock price. However,
yes, after Ramadan, Dr. Muhammad, inshallah, we will have some webinars to discuss this idea, and we will announce it on our website for registration, inshallah.
Inshallah. And we cannot do this actually until we will be familiar with the fundamental principle for the financial and fundamental analysis. I mean, you cannot jump to calculate these things before understanding why we use discount rate and what kind of discount rate and what does the present value mean. So you need to learn first about these things before we're going to do this.
And also, I would like to add something, Dr. Muhammad, here, that even before knowing fundamental analysis and calculating the value of a company, it's important also what Dr. Muhammad has gone through now, financial statements, and how to read the financial statements. It is very important, because if you will not be able to read properly the financial statements, you will not be able to do the analysis. So that's why we start always our programs with financial statements. I would also see with Dr. Muhammad if we can have one session, inshallah, next month about only financial statements, because today we are going only through balance sheet and income statement, but also cash flow statement is very important, how to read the disclosures and so on. So inshallah, also we can do something in June.
Inshallah. A nice question. What are the key areas to check in the financial statement of company in order to see before investment? This question is very nice. You have to look to 4 areas, and I will explain this 4 areas very soon. You need to look to the profitability. That means you have to look to the income statement and to see the different profitability ratios. You have to look to the liquidity, so you have to look to the relationship between current assets and current liabilities. Do you have enough current assets to be able to pay your current liabilities or not? You need to look to the leverage, that means debt ratio, how much debt you have. You need to look also to your sales over the time, and the relationship between your sales and your assets, which we call it operation ratios or efficiency ratios. Can we also invest in a company by seeing previous dividend paid? This is actually what we are doing in the discounted cash flow approach to determine the fair value. Usually, we are looking to the one of the famous and easy models called dividend growth models. So we look to the dividends over the long period of time, maybe 5 years or 10 years, and we try to estimate the growth rate of this dividends, and we assume that the history will repeat itself, and if the dividends has been grow in a specific growth rate in the past, that means the dividends will grow in the same way in the future. So we do estimation for the dividend in the future, and based on our estimation for the dividend in the future, we can calculate the share price. And after calculating the share price, we compare it with the market price. And if the market price is bigger than the intrinsic value, we can buy the share. However, you have to be very careful. You have to look to the financial statement to know about what is the future of the company, what type of project they intend to do. Because we have an assumption before applying this model, we assume that the history will repeat itself. I mean, if the dividends grow in the past in a specific way, they will grow in the future in the same way. So I have to be sure from my assumptions by reading the financial statement and see how the company is working, and a lot of dimension in the financial statement will help you to do this. I will explain this very soon. I will take one more question and go back to the topic, and we can continue after this. I have a question. I think we answer. Isa, we already answered one question for you, but I have to how to calculate the margin of safety and what is the main ratio as per calculating an income statement. I will answer this later. Thank you. You would like to answer, Mr. Samet?
لا خلاص ممكن you can answer محمد فخر now, doctor.
Yeah. If you'd like to answer the question of Isa, you can do it. I don't mind.
Later, maybe later.
Maybe later. Muhammad Fakhru, how to minimize the gap between cash in and out, as the cash out most of times come before cash in. Okay, this is how, there's a good question about net working capital. It's very technical questions, but I like to answer it, no problem. Now, what is the, and this is very related to liquidity ratios. We have a problem, we have a gap between cash inflow and cash outflow. Sometimes the cash inflow come after the cash outflow. That means I need to pay my suppliers before I will receive my money from my customers. How can I manage this? We call this actually net working capital management. What is the working capital? It's the amount of money you need to be able to continue in your operating cycle until you collect money, because you have a gap between cash collecting and cash paying, cash in and cash out. So you have to keep some assets with you to be able to pay your cash out until you receive your cash in. This amount of assets you will keep with you, we call them current assets. This current assets can be actually cash. You have to hold this cash inside the company. Maybe you can hold your money as account receivables or receivable notes. That means you have some commercial papers. You can borrow from banks using these commercial papers. So you will find some cash to pay your out cash flows. Also, you can invest amount of your money in securities, short-term securities, And we know that the short-term securities are very liquid. That means you can sell them very fast. So if you have to pay some money, some out cash flow, you can just sell the securities. And there are many ways to do this. You have any way to invest some of your money in the current assets to be able to cover the gap between out cash flow and in cash flow. So you need to invest money in the current assets. Of course, you can do some tricks by negotiation with suppliers, try to matching the dates, but in the end of the day, you still have to keep some liquidity with you. And this liquidity means some current assets. You need to invest money to current assets to be able to cover this gap. Now, I will show you more about this when we are going to the financial analysis. I will answer all of your questions later. So don't worry, we still have time to answer your question. Now I'm going to the financial analysis. And today I will actually present to you two different tools of financial analysis. Yeah, the first tool actually called standardized financial statement. What does a standardized financial statement mean? As you see here, the financial statement can be presented in numbers or percentage. It's better to present it in percentage to be able to compare between the different years. So to be able to compare between your performance in this year and last year, it's better to present your financial statement as a standardized as a percentage. I will show you example for this actually. I think I have example here, yeah. Okay. This is actually a balance sheet for a company in 2015 and 2016. And you can see that the assets increase, but we don't know actually, to be honest with you, how much the percentage of every assets. Maybe the cash increase and current assets increase. However, the fixed assets also increase. So which one is still more important compared to it was? We usually transfer the financial statement to a percentage by dividing every item over the total. So that's mean actually to calculate the ratio of cash, we'll divide it 84 by 3,373. So I divided the item by the total assets. And even the liabilities, I will divide the liabilities by the total liabilities. So now we understand that the cash was 2.5% from our assets in 2015. Now we increase our cash. We have more cash, 2% cash. The account receivable has been increased by 3% also, from 4.9 to from 4.9% to 5.2. So as a total, you can see that the total current assets increased by from 19% to 19.7, because actually this means actually 0.7%. However, that's mean that your fixed assets decreased by 7%. So that the firm turned to increase the liquidity. By the way, when you increase current assets, you increase your liquidity. Again, I can do very similar analysis for this company by turning the income statements to ratio also. So, but this time by dividing every number by the sales. So for example, if I would like to calculate the cost of goods sold, I will divide it 1,344 by 2,311. So the sales itself will be 100%, cost of goods sold 58%. So now I know that.
Sorry, Dr. Muhammad, for the interruption. There was a question that I noticed. What is COGS mean? Here is the answer: cost of goods sold. just for the people to follow us on that.
Yeah,
Thank you.
thank you. Yeah, it is cost of goods sold. Yeah. So now I know that actually, rather than knowing that I'm making, for example, in the previous slide, my profit or my net income was 363,000 or whatever. Rather than expressing my net income as an amount, I can now express it as a percentage. It is 15.7%. That's mean actually my net income is 15.7% from my sales. Every $100 sales, I'm making 15.7 from this $100. And I decide to make dividends 5.2%, and addition to return the earnings would be 10%. So this is actually make it easier to compare between different years and to compare between different companies also. Another important or very important tool is the financial ratios, and it is more informative compared to this tool. What is the financial ratios and why it is important to calculate financial ratios? If you are suffering from a problem in your car has a problem, but you don't know about the problem, or even not really a problem. If you would like to renew your license and you need to do investigation for your car, when you go to the investigation center, they investigate for tire, they investigate for engine, they investigate for body, for brakes, everything. So you need to do a lot of tests to see if the car is working fine, what is the strongest part of the car, and what is the weaknesses in the car. You cannot understand anything about the car until you do all checks. You have to use many tools to understand the car value. If you are going to buy a new car, you have to take the car to the investigation center to look to the paint, to look to the engine, to look to the chassis, to look to every part, to understand what is the weakness and strengths in this car, what is the good point, and how much the car, the price of the car should be. So this is what we are going to do in the ratio analysis. As I mentioned before, it's not about calculating ratios, it's about understanding ratios. For example, if you tell me that, from our previous example, we are making 15% as a net income, looks very nice, looks very good, but I have to ask myself, what about other companies which are working in the same sector? Are they making also 15% bigger, lower? For example, if other company, the same sectors, making 20%, that means this firm is not nice enough. I have to transfer my money to the other company if the other company has the same risk, by the way. And this gives us a lesson. You cannot depend only in one ratio. You cannot look only to the dividends or profitability. You have to look also to the risk. However, to use financial ratios, it's not only about comparing your performance with others. You need also to compare your performance through the time. So, for example, most of communication firms in the first few years, they are making loss. But if you look to the performance over time, they have negative 3% net income. They have zero net income the second year. Third year, they have 5% positive. In the fourth year, they have 10%. What happens? The profits are going up. What does this mean actually? That means actually the performance is enhancing. That means it is a promising firm. So you need actually to understand how the financial position of the firm, how healthy is the firm. You need to compare the performance of the firm by the firms who are working in the same sector and also over the time. So we have actually something called cross-section analysis, panel analysis, and benchmarking analysis. Benchmarking analysis, that means you are comparing yourself with a company which is very similar to you, a competitor, a main competitor. Imagine Nissan I will compare myself by Toyota. We have the same size, we have the same type of products, we target the same market. So our profitability, our things, I would like to be sure that we are doing better than them, or at least we are doing as them. This is called benchmarking analysis. The cross-sectional analysis means I will compare myself with people who are working in the same industry. So Nissan, rather than comparing itself by Toyota only, they will compare themselves by the sector indicators. That means the average of the sector, the average of all firms working in this sector. We call this cross-sectional analysis. The panel analysis, that means I will going, time series analysis first, that means I will going to see the performance of the firm over the time. So I will look to Nissan this year and previous year and year before to see how the liquidity improved over the time, how the profitability increased over the time. Panel analysis, that means you are making all this type of analysis together. So I will look to the firm over the time, and I will also look to the firm and I will compare it with other firms in the same sector. This is very important. Why this is very important? Because if you are investors, you need to look to this indicator to decide which firm deserve your money, which firm deserve your investment. If you are creditors or suppliers, you have to look to this ratios to be sure which firm you have to sell to them, which firm you can give them credit. If you are actually a bank or financial institutions, you need to look this. If you are managers, the board of directors themselves need to check for the performance of the firm. Now, what kind of ratios? Actually, there are many ratios, but today I will discuss with you the most important and famous ratios. We have liquidity ratios, and sometimes we call them short-term solvency ratios. The liquidity ratios, it's actually related to liquidity, to the current assets and current liabilities. You have enough current assets to be able to cover the gap. I will go to the question of Mr. Muhammad Fakhru. You have enough current assets to cover the gap. You have enough current assets to be able to pay your current liabilities. Do you keep enough current assets to run your work to be able to pay your current liabilities? The second group of financial ratios, financial leverage ratio or long-term solvency ratio. And this is very important, by the way. How much debt you have? Are you going to depend on your money, that means equity, or on leverage? By the way, the leverage, increasing leverage ratio is not something bad at all. Sometimes it's good, sometimes it's bad. It depends what in your profitability. If you are able to take loans and to invest the money and making good profits and repay the loans, your profits will increase and your profitability will increase. If you are doing good job by taking the proper money in the proper time and invest it in the proper time, this is a good point. But actually, if you are not making high profits enough to pay the interest, it's a big problem. So you have to look to the financial leverage ratio and to the profitability ratios and your sales ratios, and to see if you are really working good or not. What this actually teaches us, one ratio never be enough. It just gives you a part of the picture. If you would like to have the whole picture, you need to look to many ratios before making your decisions. And the good news, most of websites now doing the ratio calculation for you, so you can just look to them ready-made and decide. The third group of ratio is the asset management or turnover ratios. Sometimes we call them efficiency ratios, operation ratios. It's related to how you manage your assets, how much sales you are making from using your assets. The turnover ratios is something very important because it gives you indicator about the future of the company, the sustainability. If this company is able to continue, is able to run their assets in a proper way and making a huge amount of sales, if this sales increase over the time. The fifth group of ratios is profitability ratios. Of course, we would like to increase our profitability, so it will be something nice to increase the profitability, but we don't use a one profitability indicator because there are many types of profitability indicators, and every indicator actually uncovers specific type of cost and revenues. And you have to look carefully and understand the difference between profitability ratios, because it's very big difference between return on equity, for example, and net income, for example. I will explain this soon. Finally, the popular ratios, market value ratios, which is the ratios related to the value of the price, the value of the stock, and this is usually used by investors, which this kind of ratios help investors to take decisions about buying and selling stocks. Let's. This is actually a summary for the ratios. The first ratio, as you can see, short-term solvency or liquidity ratio. This contains from three ratios. We have current ratio, quick ratio, and cash ratio. What's the difference between these three ratios? As I mentioned before, short-term solvency ratio or liquidity ratios cover about does the firm has enough current assets to pay its current liabilities. Do we have current assets enough or not? So the current ratio, very simply, is just dividing current assets over current liabilities. I will give you a simple example here about how to calculate this one and why. If we go back here, I think we have a nice example. Yeah. Okay. So this is actually a very simple balance sheet, and I will do calculation first for the current ratio. As I mentioned, the current ratios equal current assets over current liabilities. You can see here the current assets, the total of the current assets is 708, because we have cash, account receivables. Remember, account receivables are your customer inventory, and the total is 708. I will divide this by the total of the current liabilities, which is 540. These are total, which because we have only two types of current liabilities, account payables and non payables, and this will be 1.31. What does this mean? What's the meaning of 1.31? That means I have current assets equal current liabilities 1.31 times. That means every $1 current liabilities, I own $1.31 current assets. So does this mean I'm able to pay my current liabilities? Looks nice. I have $1.3 current assets for every $1 current liabilities. But what happens if there's some delay in account receivable? What happens if I cannot sell my inventory and I don't have enough time to collect the money from selling the inventory? So I need to compare this ratio with the industry ratio. Usually the industry ratio is the average of other firms working in the same industry. So if this is a balance sheet of, I think this is a retail company, that means I have to go to the retail industry, calculate the average of the current ratios of the retail industry, and this actually is published on the internet. For example, Yahoo Finance, investing.com, you can find the industrial ratios there. So I will compare now, I'll find, yes, this is a good ratio or not. So if the current ratio in this industry is 2, and my current ratio is 1.3, that means I don't have enough liquidity. That means I don't have enough liquidity to pay my current liabilities. That means my liquidity is less than the market. This is very risky. Okay, the second ratio of the liquidity ratio is quick ratio. What does the quick ratio mean? The quick ratio, that means the current ratio after excluding inventory. Why we exclude inventory? As I told you, inventory is the less liquid compared to the other current assets, because you need more time to sell liquidity. because it will take longer to sell liquidity. Because even if you are going to sell your liquidity, maybe you have to lose money. You have to make reduction. You have to give discount to be able to get rid of the liquidity of the inventory. So the quick ratio is the current assets minus inventory over current liabilities. Sometimes we call it asset test, and it is very low here. It is 0.53. What does this mean actually? That means every dollar I have to pay, I owe in only 0.53, which is actually mean I am in not a good shape. This company suffer from a liquidity problem. This company has a problem with their suppliers, and that means their operation can stop. Of course, we have another ratio, which is a cash ratio, and the cash ratio just measure how much cash you have. How much cash you have to compare to your current liabilities. So just cash over the current liabilities. This is the first group of ratio. As you see, it just uncover you how much liquidity you have. The second group of ratio is the long-term solvency, which is the leverage ratio actually. Increasing leverage ratio can be something wrong, can be something risky, because if you have a lot of leverage, that means you have a lot of obligation. Remember, the debt is a fixed term obligation. That means you need to pay the interest rate whatever your performance is. However, increasing your leverage can bring more profits because you can invest more in different projects. So the firm, by taking debt, they have to compare between benefits and cost of debt. That means the financial distress cost and the benefits from taking debt. These ratios, we have three ratios at least. Total debt ratio, which is the total assets minus total equity over total assets. So in this case, for example, the total assets is 3,588 minus total equity. The total equity here, which is retained earning and the common stock and surplus, 2,591 over the total assets, it is 0.28. So that means actually I have 28% debt from my money at the total debt ratio. We have to compare it with other firms. For example, in the same sector, 28% looks nice in Qatar because firms in Qatar usually doesn't use a lot of debt. So 28% is not too bad. You can find that the other firms in the same industry taking 30 or 35% debt. But maybe if I'm working in the United States, I'm looked to the other firm in the same sector, I'll find that their debt is 60%. I have only 28%. In this case, I have to ask myself why. Why this firm doesn't have a lot of leverage? Maybe they don't want. Why? They don't have a lot of project to invest in. That means their profitability in the future will not be very big. You need to examine the reason behind this, because actually financing yourself by debt is cheaper compared to financing yourself by new equity. Another debt ratio is debt equity. It's just very similar, but rather than dividing by total asset, I will just divide it by total equity. So in this case, I just divided the ratio of 0.28 by 0.72. What's the 0.72? It's a total equity. Because we know that the equity and liabilities equal 100%. So if I have 28% debt, you will have 72% equity. We have also equity multiplier, which is actually total assets over total equity, and this actually will be 1 over 0.72, again, 1 which is 100% assets over 0.2. This will be 1.38 actually. And this means the equity multiplier, that's mean actually what is the total asset. So from every $1 from your pocket, you invest in 1.38 total assets. This ratio increase again. This can be a good indicator or bad indicator. You have to look to the history of the company. And you have to look to the other ratios. If you increase your debt and your profits increased other results, and you have a good liquidity and good sales, that's fine. You are doing proper thing. It's not about the source of money. It's about how you are going to use this money. But if you find that you reach a very high level of debt, 70%, 80%, this can be a warning. This can be an alarm. You need to take attention. You have to check if there is something happening in the company or not. The fourth ratio from the debt ratio is very important, which is time interest earned. And time interest earned is measure how much money you have to pay your interest. It can calculate it by dividing EBIT, which is earning before interest and tax, over the interest. So we have EBIT here, 691 over 141. This 4.9 time. That's mean you have earning before interest and tax 5 times compared to your interest. That means you are able to pay your interest. This is very important indicator, because that means you are able to pay the interest, so that the leverage or debt doesn't cause a big problem for you, because you have enough money to pay interest. Another one, cash coverage, which is actually EBIT plus depreciation over interest. And again, it measures how much time you can pay your interest. And if this one increase, that means you are able to pay the interest and it is safe to take loans. If I move to the third category of ratios, which is actually asset management ratios. What this kind of ratios cover actually? It covered how much the management is efficient in running the activity, how much sales they are making. We are making good sales. Usually the turnovers, this type of ratios has turnovers and periods. We would like to increase the turnovers usually and to reduce periods. For example, inventory turnover. What does the inventory turnover mean? That's mean how many times you sell inventory in the year. Yani imagine that you have a bookstore and you are buying books, put it in the shelf and sell the books. And when you sell the books, you have new money, buy more books, sell the books. So how many times your shelf has books and you sold the books and resold it again? So if your inventory turnover increase, that means you are doing a lot of operation. That means you have a good sustainability. That means you are able to generate profits from your sale in the future. That means you have good customer relationship. That means you are doing well. How can we calculate the inventory turnovers? It's the COGS, which is actually cost of goods sold, cost of goods sold over inventory. And we can bring this information from the income statement. In the income statement, you can see the COGS is 1,344 over the inventory, and the inventory we can bring it from the balance sheet. I think we have heard the inventory 422. Yeah, so 3.2 times. That's mean our turnover 3.2 times. That's mean we will actually sell our goods 3.2 times a year. So our inventory will be moved 3 times a year. Of course, if you would like to increase 3.0 times, maybe good, maybe bad. You have to look to the other industry. For example, if you speak about Lulu and Mira or Carrefour or whatever, this is very low. They would like to have a turnover 50 times per year, because they would like to do it like 1 weekly. Yeah, every week they have a new vegetable, fruits, whatever, and sell it. So 3 times, yeah, it's not. But if we speak about airplane industry, it looks good. Yeah, it looks good. They will not expect that they will have inventory turnover bigger than 3 times. So the important point, look to the industry, look to the benchmark, look to the history, look to the time series trend. Days sales in inventory, this is actually the opposite of the previous one. This actually tell you how many days you keep your inventory, and you would like to reduce this time period. And we calculate it by just dividing 365 by the inventory turnover, which we calculate already 3.2. So this will make it 115 days. What does this actually reflect? That means you are keeping your inventory 115 days inside the firm. And we would like to make this time shorter. Why? Because when you're keeping inventory, you don't have cash. When you're keeping inventory, you need to hire places, you need to book people. You may have some loss because the inventory can lose some of its value by stocking it. So this is the second inventory ratio. We have many inventory ratios. For example, we have receivable turnover. And the receivable turnover, that means how fast I'm collecting my money. You are selling to the customer, collect the money, reinvest the money again, make a new sale. So you would like to increase again the receivable turnover. And we calculate it by dividing the sales over the account receivables. So the sales here is 2,311 over the account receivables, which is here, I think, 188. 12.3 times, that means I'm collecting my money and resell and collecting again 12 times per year, which is good. And we have days sales receivables. That means how many days you wait until you collect your money, and you would like to reduce this amount, as I told you. And we calculate this by dividing 365 by receivable turnover. So 365 over 12.3, it will be 30 days. We have the same ratio for payable, and the payable turnover is the cost of goods sold over the account payable. And this actually measure how much time you take to pay. So 3.9 actually, that means you are taking, you are paying your money 3.9 times a year. And you need 94 days to pay your money. Always we try to compare between these two ratios, days sales and receivables and days cost payable. You collect your money in 30 days, but you have to pay in 94 days. This is good. Yeah, smart companies try to make the payables period longer compared to receivable periods. So of course, this happens through good agreements with the suppliers. So they have enough time to cover themselves. I need 30 days to collect my money, but I can pay my due money in 94 days. Assets turnover ratios, and the asset turnover ratios measure actually how good I'm using my assets. Some companies have a huge amount fixed assets and making a small amount of sales. So I need to know how much really I'm doing. So by dividing the assets, the sales 2,311 over the total assets, which is here, I think 3,588, we have 0.64 times. What does this mean? That means every dollar fixed total assets I'm owing in the firm, I'm making sales 0.64, and this is a good ratio. If it is increasing, that means the firm is doing well. That means we are utilizing our assets in a proper way. Now the simple profitability measures. There are many profitability measures. One of them is the profit margin, which is net income over the sales. And of course, we get the net income over the sales from the income statement, and it is 15%. After that, we have return on assets, which is actually net income over the total assets, and this is 10%. What's the difference between these two? And the third one, actually, return equity, which is return, the 363, over the equity. This is 14%. What's the difference between these three ratios? Very important, actually. The difference between these three ratios are very important. As I mentioned to you, every profitability measure, there are many other profitability measures, by the way. I just focus on the most important. Every profitability measure has different meaning. The profit margin tells you how much profit you are making from your sales. That means if I sold this phone for $1,000, I will make $157 as a profit margin. Return on assets, that means how much profit I'm making from my assets. If I already invest in this project 10 million, I will make 10% as a return on assets. This 10% is return for both stockholders and bondholders. So this is more important compared to profit margin. The profit margin is important for evaluating the sales department, the production department, whatever. But as an investor, I will put more weight on the return on assets because it's reflect how much risk this firm has, how much profit should I expect from this firm. Return on equity is 40%. Return on equity, this is how much you get in your money as a stockholders. You can see the return of equity bigger than return of assets, of course. Do you know why? Because you are not only make the 10%, you are making also the difference between the cost of debt and the return on assets. What does this mean actually? This means as a stockholders, imagine that you are investing $100 from your pocket and you will make 10%. And you will borrow another $100. Your firm will borrow on behalf of you $100 and they will pay 6% as an interest rate. Now the firm will invest $200 and you will make 10% from your own money, and from the borrowed money you are making 10% minus the interest rate, which is 6%. That means you are making 4%. So that means your total return on equity 14%. Of course, mathematically, it's not will be accurate 100%. I just try to give you example to understand the idea. So what does the return equity mean? That means the stockholders will make 14% from their investment in their company. If you own stocks in this company worth $100,000, you are making $14,000 as a return on equity for this year. That means they will give me the $14,000 in cash? No. This is your earnings, not your dividends. Whatever they decide to give you in cash is your dividends, and this is a different story. I think we have done the 4 groups. We still have the 5th groups, which is the market value measures. I know that most of people focus on the market price, PPS, price per share, and the number of outstanding share. You have to look to these 2 things. The first indicator or ratio is very famous, EPS, earning per share. How can we calculate earning per share? Very simple. We divided the profit, net income, the 363, if you remember from the net income statement, over number of share outstanding. So it gives us $11. What does $11 mean? That's mean the earning per share is $11. Every shares deserve earnings $11. This is not a cash, it's just earning. And the firm will decide how much of this earning will be distributed as dividends and how much of this earnings will be retained inside the firm to reinvest in the future. And this number, of course, if this number increases over the time, or if this number is bigger compared to the other firms working in the same industry, this is something good. That means the performance is good. That means this company worth to invest in. BE ratio, the BE ratio is a PBS over ABS. That means actually the market price over earning per share. So let's assume that the market price of this company is $88 over the earning per share, which is $11. We had BE ratio 8 times. What does this mean? That means the price to earning is 8 times. That means every $8 I pay in this stock, I will get $1 as earning. Increasing this ratio mean that people overvalue the firm a lot and they trust the firm a lot. Decreasing this ratio means that that this share is undervalued. However, we would like to invest our money in a firm with PE ratio between, let's say, I would prefer between 7 and 15. Why? Because if it is less than 7, I will have to ask myself, why this company pay me so much? Only I invest $7 to get $1? Wow, why? Maybe the company has a lot of risk. I have to be careful about this. If it is bigger than 15, that means I'm paying $15 to get $1 as earning. I can't even put my money in the bank. The bank will pay me more. So why I have to pay all this money? So I have to think about it. However, maybe the investor in the market are happy to pay higher price compared to the E ratio because they have information about the future of the company. Maybe the company currently doesn't have a lot of earning, but they have a lot of patent projects, and they will make and achieve a lot of earning in the future. So you have to consider also the disclosure. Remember disclosure notes? Another market ratio is a price sales ratio. Again, it's a market price over the sales ratio, and the sales ratio is the sales per share. So I will divide the number of sales, I think it was 2,311, by outstanding share, which is 33. So give us 1.26. What this mean? Actually, that means I'm paying $1, and the company used my $1 to achieve $1.26 as sales. Including this one, that means this company has a good sustainability. They are making good price. Market to book ratio, this is very important. What is the book value of the stock, and what is the market value of the stock? The market value is the stock price, and this is changed. The book value is the total equity in the balance sheet, which is capital plus retained earnings plus surplus. And we usually divided this total equity by number of share outstanding. So the book value equal total equity divided by share outstanding. So in this case, it's 78. And market value over book value. We know that the market value is the price, 88, over the 78, which is a book value, it is 1.12. That means the market value bigger than book value. Usually this ratio, increasing this ratio means that the market believe in this company, and this company is a growth company. What is a growth company? A growth company like Microsoft, like Facebook, like Yahoo, like Google. This company doesn't have a lot of book value. They don't have a lot of assets, but actually they have a lot of projects, a lot of promising projects which promise a lot of cash flow in the future. So people are happy to pay more money as a price for the stock compared to the book value. Again, I will not invest in a share has a market value bigger than the book value 3-4 times here. No more than 3-4 times, because actually I would be afraid it will be overpriced, unless it is really a promising company, has a good future. But if I would like to be conservative, I would like to look to a company has a market to book ratio around 3, for example. Again, be careful. These numbers and these examples for me, it's just general examples. From sector to another sector is a different story. You have to look to the market value, to book value among the same sector. So because when you speak about American market is different from Qatari market, and speaking about industrial market is different from retail, is different from energy, for example. So every market has its own characteristics. That's why we have to look to the whole picture. Let's go to the whole picture, and I will give you a final slide about the financial analysis before we are going to the second break, and how can we get a full picture together. This is the best way to do your analysis. This table reflects the financial ratios for a specific company, just an example company, proposed company, from year 2001 to year 2005. Also, we have the industry average, and we have the competitors. So now, if you would like to know if your performance is good or bad, you have to compare your performance over the time, your performance with the industry average and with the competitor. You can see here from the gross profit margin, you are making 52% gross 2001. And by the time it's increased, which is good, looks nice. That's now, what's the gross profit margin mean? This is actually the profit margin is the difference between sales and cost of goods sold. That's mean you have good sales or you reduce your cost of goods. However, and you are much bigger than the industry, so you are doing good, that's fine. This company has a good sales policy and they are saving in the direct cost. However, the competitor is much better than us actually, 62%. It's not much better, 3%, but it's better than us. If we look to the same thing in the net profit margin, you will find that the net profit margin was fluctuated. However, it's increased in 2005. We are bigger than the industry, and even we are bigger compared to the competitor. What's the difference between net profit margin and gross profit margin? The net profit margin is after taking out indirect cost. That means we may have less indirect cost compared to our competitors. Maybe the competitors make a lot of sales because they have promoting activity and whatever, but we save some money here. Now, if we look to the return on equity, which is much more important compared to the previous one, we'll find we are making 25%, which is bigger. We increased our return on equity over time. We are moving in a good way. And we have bigger return on equity compared to the industry. However, our competitor has 29%. Maybe he is more debt. That's why he are able to make 29% for his shareholders. Now I have to think about my leverage policy. Should I take more debt to invest more money to make higher return on equity to my investors or what? If I look to my return on assets, yes, my return on assets was 12 point, jump to 14.4 in 2003, go down in 2004, but jump again in 2005 to 18.4. Now my return on assets is bigger, not only bigger than my industry average, but my competitors. That means I'm using my assets in a good way. Maybe I just need to change my finance way. Again, you can look to other ratios in the same way, to the inventory turnover, to receivable, to current ratio, of course, to uncover the development and the performance of the firm. If you look to PE ratio, price earning ratio, you can see the price earning ratio increasing over the time. And it is 11.8, which is good, not bad. And it's bigger than the industry. That reflects that people trust our company. Maybe the competitor has a higher one, 13.1. Maybe people would like to invest more in our competitor compared to us because the competitor gave them higher return on equity, 29%. So this attracts investors to invest in this company. Market to book value, it looks fine, 2.9, 2.6. It decreased in one. That means we face a huge decrease in the firm price in 2004, but it increased again to be 2.8 in 2005. And again, market to book value ratio for the competitor is slightly higher, maybe because they have a higher, as I mentioned, return on equity. This actually very simple analysis. I wish I can give you more details, but we have the time limitation. So I have to stop now to take some questions, and after that I will go through the third part of the lecture, which is the technical analysis. We have 19 questions. Thank you, Mr. Isa. The second question by EBS, can we calculate the company dividend in the year end? We can, of course, we can predict the company dividend using the EBS, but again, you have to use historical model. We will explain this later in another lecture. Mr. Fatih, what happens when an asset is at salvage value, end of its producing capacity? You are invest for money, same time this means you have an assets again that depreciate, also a liability, loan pay, and it's become a cycle. If I understand your question, Mr. Fattah, because I'm not really understand what happens, I will take the first part of the question. What happens the assets as a salvage value? That means there is no depreciation, yeah? So you will not calculate depreciation anymore. You don't need to calculate depreciation for the assets. Usually firms in this case actually, we call this actually secret reserves. It's a secret reserves. So because actually the asset has a value, you're still using the assets, but you don't need to calculate depreciation. The assets will not appear in the book, in the balance sheet. Also, you still use it. So that's why we call it secret depreciation. The second question from Mr. Pedro, the situation, do you think analysis should be fundamentalist? This is a good question, actually. This is a good question. Mr. Pedro speak about the current situation, should be fundamentalist. In the current situation, especially Corona, actually, the Corona come with a lot of opportunities in the stock market. It's not only a crisis. Always when you have a risk, you have opportunity. If I were you, yes, I would be fundamentalist, very fundamentalist. I have to look especially about the sector and which sector affected more. However, I have also take my point, the trends, what happened to the prices, which stock lose most of its value. I have to focus in sectors, what happens after Corona, what we can learn from Corona, which sector should have higher. For example, if I were you, I will look to sectors like health sector. However, if we think fundamentalistic and also from technical point of view, you'll find sectors like tourism, like energy, lost already a lot of value. So you have to think about them again. I don't think, maybe other sectors like construction or whatever will need more time because they take time to work again. So you have to consider both fundamental analysis and technical, but yes, before everything, I will be very conservative. I will try to be very fundamentalist, because actually, even if the market is, it will be very difficult to play the psychology of the market now, because I believe Corona even will change our psychology, our way to make decisions. So it's better to depend on financial figures rather than our reactions. What's your opinion to invest in large cap, mid cap, or small cap to minimize risk investment? This is a good question. Okay, small cap has higher risk, but has higher return. No free lunch in finance. If you would like to have higher return, you have to invest in something have higher risk. We have something called small size premium. And the small size premium is the difference between the rate of return and small firms and big firms. And this premium is positive. That means small firms will pay for you higher return compared to a large firm. However, they have higher probability of fluctuation. Easily, because they are small, easily they can lose their value. So you need to be careful. However, if I were you, I will make a portfolio. This portfolio will contain a few small cap and few large cap. Also, when will the Qatar correction or recession will overcome? This is a good question. I mean, I'm not sure if you ask about Qatar correction or recession will overcome. This is a very good question, but now we work under two different crises. I think one of these crises we already passed. you can see that if you look to the Qatar stock market indicator in the last 3 years, you will find that we overcome the overlooked problem. However, for the corona and the impact of the corona on the stock markets, I can see if most of markets in the world, if you look to the financial markets, by end of March, we have started the reversal trend. I mean, the financial markets, all the financial markets have witnessed decreasing trend from January, some of them from February. However, by end of March, most of financial markets, I can share with you some graphs. I think I have some graphs about this. Maybe in the end of the lecture, because in the end of the March, most of the financial markets start to go up again. Why? This is another question. This is a big question. So yeah, Qatar stock market is recovering, but you have also to be careful now. It's moving now. I don't think we will lose. I mean, the stock prices will be lower in the future. I believe that the market is working very well now. Even you can see when we have some decreasing trend the prices, it's just very small trading volume and very small amount. Next question. As per the current situation of the market is investing in pharma companies such, it's a good decision, but I'm not in a position to give you any investment advice. I'm not allowed to do, by the way. But yeah, pharma companies are good, but again, you have to see how the prices moved. If already the prices has increased a lot in the previous year, you have to think about other fundamental indicators. Which sector has promising future in the next 3-8 years? Oh, big question. I think technology, it will be very important. Educational sector, especially educational solutions. Health sector, I think it will come again. And you will surprise my friend if I tell you energy sector also. Because actually, considering the current prices, I think in the next year, at least for 1 year, if you are long-term investment, I will emphasize biotechnical, health sector, technological sectors. This is very important, I think. Pedro again, where can I find information about dividends? Okay, all these things you can find in many websites, in the firm websites, in Qatar Stock Exchange websites, in Financial Times website, Yahoo Finance website, investing.com website, Mubashir website, so you can find it everywhere. And if you, I think many other firms has websites. But to be honest with you, some websites ask you to do a premium subscription to get more detailed information, and this makes sense, of course.
Dr. Muhammad, excuse me, sorry for the interruption. Also for answering Pedro's question, all this information can be found on Qatar Stock Exchange website for free. If you go to the listed companies section on the website and you choose which company that you want to know the information about, then you choose the company, and then you can find all the information, all financial statements, price, different market prices for, since inception or year to date or monthly, whatever, and also the
do you mind to share this with them now? I mean, we can go from this questions just for a second. You can share it online with them.
No, yes, of course, no problem. Let me share my screen.
Okay, give them an example. It will be much better. They will be more happy, I think.
Okay. Hold on a second, please. Yes.
Your time.
But I will stop your sharing, doctor, and I will share my screen, and then you can continue later.
I stopped. No problem.
Okay. Here is the Qatar Stock Exchange website, qe.com.qa. And then you can find on markets, if you press on markets and then click on main market, click on listed companies, it will open all listed companies categorized by different sectors. So you have banks and financial services, you have consumer goods and services, and so on. If we go, for example, to QNB, then here you can find a chart for QMB prices. This is by default, it opens for 1 month, but you can increase to 3 months, 6 months, 10 years, whatever. The S here gives you the important information that happened on that day that maybe caused the price to increase or decrease. 3 year and so on. Here you can find, this is today's last trade price and what is the change. It decreased or the price dropped today by 15 dirhams only. And this was the previous close of yesterday. Here is a very important 3 ratios. Maybe Dr. Muhammad has covered today. The PE ratio of QMB, it's 11.07, Doctor, and maybe you can
Very nice.
give us your opinion on this PE ratio. EPS for this year, for 2019, of course, 1.55. This means that the earnings per each share of QMB, 1 riyal and 55 dirhams. And here is the yield, which means that if you divide the cash dividends that you take from the bank over its market price, it gives you this percentage, which we call it the yield. And usually people are comparing this yield with, of course, like Dr. Muhammad said, the average of the industry, other main competitors, and also with the interest that you may take from a bank if you have a deposit. The more the yield for some people, if they are looking for cash dividends, investing for dividends, the more the yield, of course, the more attractive the company. But for people who are investing for growth, maybe this is not, they wouldn't mind that percentage of the yield. Sometimes they don't want to have yield. They want the company to reinvest its dividends or its profits, in growth projects that will be reflected on the price in the future and make it higher. So then you can go to the news. All the news here will give you back. The last AGM, I saw another question when the dividends is determined. It is determined in the AGM, the annual general meeting for every year. So I think QMB has already had their AGM in February, and they decided to pay 0.6 riyals dividends, cash dividends. And here you can find the statements, all the financial statements. Was 2019 until now. In 2020 they issued only the first quarter. Also there was another question. Yalla, answer all questions relating. Dr. Muhammad, I saw that someone was asking whether the companies are obliged to disclose the financial statements. Listed companies, yes, they are obliged to disclose the financial statements 4 times a year, first quarter and the semi-annual by the mid-year, 30th of June, and then the third quarter, and then the annual, of course, at the end of the year. And then there is a profile of the company and the board of directors and so on. This is it. I don't want to take much time from Dr. Muhammad. Let's go back to Dr. Muhammad. I'll stop my share and you can share your screen now, Doctor.
This is very important and very interesting. That's why I'm asking you to share with them. You can find most of the information in the Qatar Stock Exchange, as Mr. Samer mentioned. And when I mentioned other sources, I mean also for the international stock market. Yeah, if you are interested in the international stock markets. But of course, you can find most of your information in Qatar Stock Exchange. Now we are going to the third part of the lecture. I think we are going to the technical part, if I'm not mistaken. And after that, we can answer technical analysis. Just to remind you, when we start the technical analysis, it's analysis based on the movement in stock prices. What happened in the past will repeat itself in the future. This analysis assumes that the movement in the stock price will determine the future stock prices. So it's based on trends, charts, supports, resistance, ascending, descending, channels, Japanese candlestick, Fibonacci, a lot of tools actually. Let's start by the trend line. The most important point in the technical analysis, you try to understand the trends. What is the trends? The fluctuation stock price. So we just try to have a chart over long period. As I mentioned before, you can do it even 1 year, but you will take your observation will tick by tick. I mean, minute by minute, or 1/300 part of minute by observation. And after that, you try to understand what happens actually, what kind of trend we have. You can see if we put this movements in one trend. So for example, if I just drew a line between the spikes and the lines between the bottoms, so I just connect the bottoms here and connect the spikes there, you will have the trend. So you can build the trend by just graph the spikes and the bottoms. And this line called resistance, which is a line drawing over price spikes. And this line called support, which is a line drawing under the price's bottom. So what is support? What is the resistance? The resistance is the price when the investors believe the price is too high. So they lose the interest in the share. So they start to sell the share because they believe it's too high. Now it's time to gain. So the price will go down again. And the support line, it is the price when the investors believe, yeah, this price is very low and it's good opportunity to buy this stock again. So they start to buy the stock, so the prices will go up again. So that means that the stock will move between the resistance lines and support lines. But however, it is in increasing trend. You can see that the trend take this direction, increasing trend. If what happens if the price break the resistance or support line? If this break for the resistance or support line are small volume of trading, is not important at all. Doesn't mean anything. It's just random occurrence and will come back again. However, if this break happens with a good number or a good volume of trade, that means a big amount, this actually means we may have a new support and resistance line. So this is a resistance, this is a support, and this is actually a horizontal channel sideways, but sometimes it's taking upway or small way. You can see here, for example, an example when the stock price break the resistance and with a good volume of trading, and now we are moving to a new resistance point and support point. So that means the resistance line will turn to be support. So when the stock price breaks the resistance line at a very good volume of trade, this will give us indicator that we now have a new resistance level and have a new support level, and the stock price will have a new cycle of increasing. And we should actually, in this case, if this break happen, we should buy the stock because we believe that we will achieve good profits. Sometimes the channels are ascending channels, and the ascending channels happen when the high price increase over the time. That means actually the highers get higher over the time, and ever the lower prices is increasing over the time. So if you have these two positive sloping trend lines, that means we are going to uptrend. That means we should expect that the price will increase over the time. And sometimes we have something called descending channel, as the descending channel happens if we have lower highs and lower lows. That means if the price, the lower high increase. For example, every the share price go to 10 and 5. After that, go to 9.5 and 4.5. After that, go to 9 and 4. So every time when it go up, it doesn't go up a lot, and when it go down, it goes down a lot. So this actually means we are facing a downturn trend in the stock price. Another pattern is a very famous one, actually, head and shoulders. And in this case, actually, the stock price go at the left shoulder, the price increase and go down, and increase double the first increase and go down again. So we shouldn't expect it to increase again. If you just draw a line between this, it will be a neckline. This left shoulder head can repeat itself, and sometimes if the right shoulder break the neckline, we expect that the price maybe go down by the same amount or the same space between head and neckline. So for example, if the difference between head and neckline $2, so we expect that the stock price may go down by $2, but it will come back again. And next time it will go deeper, for example. So we have to be careful about this. These are real examples for two stocks. You can see the left shoulder here and head, right shoulder, and the price really go down. And after that, start to again to make a left and head again. So we should do our expectation this way. And the second example is very similar, actually. Sometimes we have head and shoulder reversal. So it starts by decreasing the price, not increasing the price. So the price will go down and recover and go down again and recover again and go down again and recover. And if breaks the neckline, that means we should expect that the maximum price objective will be the same difference here. The breakout is, so we should expect that the next head up will be similar to this one. And this is a practical example for head and shoulder reversal. You can see the left shoulder, the head, right shoulders, and confirmation line break. You can see the volume of trade is very high. That's why we believe that the price would be bigger than the neckline. So this is a confirmation line break, actually, and increasing and so on. Now our last example for technical analysis technique, which is Japanese candlestick. What is a Japanese actually candlestick? The Japanese candlestick is just give you an idea about the change in the price. So the body of the candle itself is the difference between closing price and opening price. Opening price is the first price when the first trade happened in the day, the first selling process. Closing the price is the last price happened in the day, so the price of last transaction. If the closing price is bigger than the opening price, the body of the candle will be green. However, if the closing price is lower than the opening price, the body of the candle will be red. This stick give you the highest price of the day. Maybe the highest price is not the closing or is not the opening. And this stick give you the lowest price of the day. If the highest price of the day is equal to closing price, you will not find this stick. It will be only the body and one stick from down. If the closing price and opening price are equal, we will have something called Doozy Candle. And Doozy Candle actually mean that the opening price and the closing price are equal. But we still have high price and low price. Highest price and low price. I will give you a pattern, two patterns for Japanese candlestick. The hammer and the hanging. The hammer happens after downward trend. If you have a big red candle, after that, if you have a small green one, that's mean in this case the opening price is less than closing price. That's mean the opening price decrease. However, the closing one increase. And long stick, what does this mean actually? That mean the market open and the prices go down, 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 and then the closing, the prices go up, up, up. So what this one tell me? This one called hammer, and this one tell me that we should expect upward trend. So the price will increase over that. In the opposite, there is another candle called hanging man, and this usually happen after upward trend. You can see here what happened. You can see that the market start by higher price compared to the previous. However, it closed by higher price. However, during the day has been a lot of low prices happened. So the minimum price was very low. This gives indicator that the market will turn to go down. The final candle I would like to explain, harami candle, which is actually pregnant. Harami in Japanese mean pregnant woman, pregnant woman. If we have downward trends and big red candle without any sticks, and that's mean what this mean without stakes? That's mean actually the opening equal to the minimum price. Sorry, the opening equal to the highest price, and the closing equal to the minimum price. And this followed by green one. That would give me indicator that the price will go up. And if you have a big green one, again. In this case, the closing price equal to the highest price and the opening price equal to the lowest price. This gives indicator to the market will turn down, followed by a red one. This will give indicator. But the main condition here that the new candle is less than the big candle. This means the market prepare itself for correction. Even here, the new candle is small than the old candle. That's mean the market prepare itself to correction in the other direction. Now, thank you for this. I will go for the questions. I know now we have, I think, more than 145 minutes, so I'll allocate 10 minutes more for your questions. How we think will telecom and public bank sector do in future? What is your future time span? I mean, what do you mean by future again? This is a very tricky question. Yeah, telecom and public banks in the future. If we speak about few years coming, public banks, I think they will suffer unless they change a lot of things in their works. If you speak about Qatar, I think public banks sector is doing very good, and it will continue doing very good in Qatar. So please try to make question more specific, which market and which time span we speak about it. Noli, what is the ideal range of PE ratio for a strong company that we can safely invest for a medium long term? Price earning ratio. This is a good question. Price earning ratio for it's a very good question. I cannot give you a rank. I think something between 7 and 15, but you have to look to other ratios also for the price earning ratio. You have to look also to other ratios to be sure. When comparing financial Fatih, Fattah again. When comparing financial analysis, looking at stock trend, comparing between various same industry, would this be sufficient? Looking at stock trend, yes, should be sufficient. Yeah, it's a very good start. Also, you can read also the analysts' reports, because sometimes the analyst has more experience compared to individual investors. So usually they give you more advice. It's a holistic thing. What I mean by holistic things, يعني sometimes it's good to look to other people's work also before making decision. Qatar market, telecom industry, and utility industry for next 5 years has good potential in terms of growth. Of course, they have. Of course, especially utility industry. Utility industry 5 years has very good potential. Telecom industry, I'm not sure about telecom industry. To be honest with you, I don't think they will be good, but they will not have a superior performance. Because the market satisfaction is very high. But who knows? I mean, the new generation of 5G and these things maybe create new products and open new markets. Louisa, how to analyze the sustainability of company from its balance sheet? Thank you. Okay, this is a very good question actually. Sustainability of the company can be analyzed from many ways, but I think one of these ways is the new indicator launched by Qatar stock market. I think Mr. Samer, your EGS?
ESG.
ESG indicator. Would you like to explain it to them?
Okay.
Yeah.
We now in Qatar Stock Exchange, we launched an initiative called ESG initiative that companies need to take into consideration not only their financials, but also they need to report on 3 activities that we call ESG. ESG means environment, sustainability, and governance. So environment, what is the precautions the company is taking, especially if it is working in industry like wuqud or in other industries that may have some pollution? What are the precautions that they are taking in order to protect environment? Social responsibility, the S. So what are the activities of the companies in social responsibility? And the third one, which is very important, corporate governance. And you know, of course, corporate governance are is the procedures taken by a company to balance between all the stakeholders of the company, whether they are shareholders, board of directors, executive management, creditors, or others. So the company that is doing good or doing well on sustainability criteria, those 3, that we have more under those 3, we have, I think, 34 detailed criteria, then this means that this company will be doing better in sustainability or in terms of sustainability.
Thank you, Mr. Samer. So you can see, Louisa, that you can measure sustainability by look to this index. And this index also available in other stock markets, by the way. And usually in research, we measure sustainability in this way. However, another way to measure sustainability from the balance sheet by looking to the operating or assets management ratios, because you can see the asset management ratios is looks to the relationship between using your assets and generating sales and generating good profits. So both of them can help you to look to the if the company has a good corporate governance structure, if the company has good practices in social, corporate social responsibility and environment, if the company has good sales, if the company has good use for the assets, if the company has good ability to collect their money, if the company has good leverage ratio, all of this mean the company has sustainable future. The second question, Isa, what do you believe how Qatar stock market will look like in 2030 vision? This very open question, Isa, I will not able to answer in 5 minutes. So I will leave this to the end if Mr. Samuel would like to answer. The second question, keeping to grow dividends and saving my capital, what terms I need to look in QSE? Keeping to grow my dividend and saving my capital, what terms I need to look in QSE? I think you are looking for stock recommendations, which I'm not allowed to do. I don't think so. But if I would ask you, if you like to keep dividends, very simple. Look to the historical company who are making dividends. Look to the firms who have a good activity, industrial activities, retail activities. Try to make a good diversification for your portfolio. Try to invest in a company who has a good long history with dividends, with operations, and with stability in the stock price. Anna Riza, can we get a copy of presentation slide after webinar? I think Mr. Samer will send it by email for people who registered. Pedro again, most of companies of Qatar PLS negative. Can you comment something about this?
I don't think so that most of companies are.
Yeah, I get surprised, but
they are, of course, you cannot. I mean, see all companies in any country that are doing profits. So, of course, there are some companies that are doing losses, but I believe most of them are profitable. Alhamdulillah. Thanks God.
Alhamdulillah, I cannot count more than 3, 4, or 5, if I'm not wrong. Correct me, please. 5 out of 47 making B negative. So I surprised with the question. Maybe you mean unlisted companies. Allah.
Maybe
or maybe you mean this quarter. Maybe this quarter. I will assume if I didn't see yet the second quarter, but I will assume most of companies in the world will not make a very good profits from March to June. And we know why. Because we are in home. Amit, can this financial analysis be applied to startups who has no or little historical financial data? No. Actually, you cannot calculate this financial analysis without historical data analysis. But for startups, there is another indicators, and I think we have Entrepreneurship Center in Qatar University. You can go to the website of the Entrepreneurship Center, and they have a lot of measurements and whatever you can use to evaluate startups. But still, there are some ways we can do it. Do you provide certificate for webinar programs? I think
not for the time being, doctor. Not for the time being. Maybe in the future, inshallah, we will do like an online certification or something. But for the time being, unfortunately, we don't do certificates until now.
Okay. I have another question from Fattah about BE ratio. Does that mean low ratio is better because higher earning per share compared to price per stock? Does it mean company will grow better, or does it have a benchmark? As I mean, Mr. Fattah, you cannot judge BE ratio unless you think about the BE ratio for most of the other companies. The BE ratio, as I told you, it measures how much you are paying to get $1 as a profit. So if the BE ratio is 15, that means you are paying $15 to get $1 as earning. Some people will believe, and I am one of these people, that low PE ratio is better if I'm going to buy the stock. But if I'm hold the stock, I will prefer higher PE ratio. If I already hold the stock, I would prefer higher PE ratio. But if I'm going to buy a stock, I will try to look to firms which has lower PE ratio, but not very low, in a range, in a specific range. This range should be compared with the industry and with the country and with the sector and with the historical performance of the firm. Why? Because actually, if the PE ratio is very small, 5, that means I'm paying $5 to get $1. That means they are giving me 20% earning. Is it too much? Why? Maybe they have a lot of risk. That's why they have to pay for me high earning ratio. I have to collect data, more data, to be able to make the decision. As I told you, my opinion, I prefer to invest something between 7 and 15. Sometimes a high PE ratio means that the company is doing very well, and people believe that the value of the company, not based only on the current earning, but they have a good expectation about the future of the company. And if you look, for example, to the New York Stock Exchange, you'll find some stocks has PE ratio 28, and these companies are very good companies. They have a lot of patent, they have a lot of projects, they have a lot of future. Most of technology firms have a high PE ratio. But why? Because even they don't have good earning, I mean, in the first 5-6 years, they will achieve this earnings later. Maybe they don't have enough earning, because remember, PE ratio is a historical ratio. You are calculating the price today over the earning which we achieved last year. So maybe you are expecting that next year earning is bigger. That's why the PE ratio is higher. Another question, I'm an investor in Qatar stock market from the last
Can I answer this question, Doctor? I will answer it privately, okay?
Yes, please.
You can you can continue other questions.
Okay, PE ratio, okay, we finished the PE ratio. Highlighted the word promising company to invest in. What do you mean by promising company improve? Promising company, so thank you, Mr. Ali, for this question. Promising company, that means the company which is able to generate higher cash flow in the future. How can I know it's a promising company? It's based on the projects the company has, the idea, the patent, the inventions, how much the market share of the company. So there are many promising companies, assuming you are able to determine what kind of patent inventions planned for this company. The expected cash flow is very important. So you need to understand, very simple answer. Does this company is able to make sales and to generate enough cash flow? If the company is able to generate a huge amount of cash flow in the future, it is a promising company. Abdurrahman, okay, this is for you, Mr. Samer.
Yeah, Abdurrahman is asking that if we can have one session on technical analysis. Of course, today it was like a very short period for technical analysis. I would like to thank Dr. Muhammad for considering this part. We will have another sessions dedicated only for technical analysis. For Arab speakers, you can attend with us. Last week of Ramadan, it will be on 18th of May and 20th of May. These sessions will start at 9 p.m. and you can register on our website. For non-Arabic speakers, maybe we will consider to have one technical analysis if you can convince Dr. Muhammad to do so in June, inshallah. Let's see. But for Arabic speakers, we will have on the 18th and the 20th of May, inshallah, from 9 p.m. In the evening.
Inshallah. Dr. Muhammad Khalaf, hi, Doctor. Just to share Khalaf. Hi, Doctor. Just to share the knowledge with no finance people, do we have ready for use systems that calculate and help perform the analysis apart from normal Excel sheets? Yes, we have. But I have to be very, it is very expensive to use these systems. Usually this system used and developed by professional trader with financial institutions. However, we also have simple applications. There are millions of applications and websites available free, and you can use the financial analysis by them. As I mentioned, Qatar Stock Exchange give you a lot of information. If you like to, if you are looking for a food, ready-made food, spoon feeding, and tell you which one you buy, you cannot consult Stock Exchange about this, because they cannot give you specific advice. But in this case, you have to deal with investment fund. They are doing all the calculation. They help you. They send you the calculation and the analysis. And there are many investment funds in Qatar. There are, I'm not sure if I can say names or not, but some brokers have the license to give you advices. Some banks have their investment arms and they give you advices. if you would like to look for a ready-made advices. If you'd like to read the analysis, somebody do it for you and read the analysis. All the websites I mentioned before, including Qatar Stock Exchange website, Finance, Yahoo Finance website, Investing.com, and other websites, all of them has ready-made financial analysis. Also, there are some applications available in Apple Store, in Google Store, related to do these things. It's up to you to use any of them.
Thank you, Doctor. Can I suggest something, because I know that you are fasting and
Yeah.
we took a lot of your time. So let me choose two more questions that I think very important. I will ask you these two questions, and please, if you can answer them, and then we can finish.
Okay.
Here, there is a question from Mr. Pedro, who says, do you think this type of analysis is more suitable for options market? I think he means technical analysis. What do you think? Is it more suitable for options market, or it can be used for all markets?
Actually, the technical analysis can be used for all markets, but I agree with you. In optional markets, the fundamental analysis can be less than the technical analysis. However, can be less. Okay, let's say it in other ways. The fundamental analysis, from my point of view, is more important compared to technical analysis in equity markets. But we cannot ignore the technical analysis. Why? Because what happens usually, Mr. Pedro, technical analysis affect your behavior. Because in everywhere we have something called the crowd herding behavior. What is the crowd or herding behavior? That means when people listen to some analysis, and the analysts say the price will go down because now we are in Ramadan, nobody buys stocks in Ramadan. Some people will be affected. Some people will not go to buy the stocks, and the price will go down. So we cannot ignore it. But the importance of technical analysis may be increasing in the option market. However, in the last week, when the oil price going to be negative in the option market, in the forward market, because the forward market is in the derivative markets, forward market is very related to the option market. It affected actually by the fundamental, not the technical. It was very fundamental. People doesn't buy oil. We cannot store oil. Now it's much better for me to lose the price of oil rather than to pay more to store oil. That's it. So it was a fundamental decision more than technical decision. That's why the price go down. What about second question, Mr. Salman?
Second question, what do you think, or what are your thoughts about ETFs, exchange traded funds?
I think this one is very important and very safe to trade in. This one has been designed and selected by the stock markets themselves. And usually investing, I think, Mr. Samir, you can provide them with some numbers about the performance of ETF in Qatar.
Yes.
If you give them numbers, I think the numbers will be much better, much more important than my.
Of course, I will give one example. We launched an ETF. We launched two ETFs actually in 2019. One of them was tracking the Qatar Stock Exchange main index, QE20. And this index made the highest performance in the world in 2018. By end of 2018, the index increased by more than 22%. And of course, this high increase reflected on the ETF that is tracking this index. So people who invested in the index, by the time they made maybe above 20% increase in their investment in just 1 year, which is, I believe it is very high when you compare it with, other investment alternatives. Other thing that ETFs provide for the investor, especially we say small investors or individual investors, that we always advise them to have a diversified portfolio. Don't put all your egg in one basket. Maybe if you put all your money in one company, and this company, for any reason, for a unique reason that is only related to this company, they made losses, you will lose with them. So it's better to distribute your money over some companies. But for small investors, it's not easy. Why it's not easy? Because maybe you will not have enough money to make this well-diversified portfolio. The other thing that maybe you don't have, enough experience to pick the right stocks. So ETFs is your way to do that, because the ETF is collecting the money from investors, and they do the portfolio on their behalf. And in return, they give you the unit. And this unit represents the diversified portfolio, which is 20 stocks at least. And also the ETF is managed by a professional and licensed management company. So it is safer in this regard as well. So I believe that ETFs for small investors, that they don't have, enough experience, they don't have, enough money to have a well-diversified portfolio. They don't have time even to, go and see the market on a regular basis. They can start their investment in ETFs, and then after getting familiar with the market, they can, do their own investment in individual stocks.
I totally agree with Mr. Samil. The ETF is not only giving you a more consistent rate of return, but also less risky, because you have a higher diversification. You invest in the market index. And I would like to stress something very important. After this lecture, after the technical analysis lecture, after many lectures, you will not be expertise in the financial analysis. To be expertise in financial analysis, you need experience. You need to try. You need to learn. You have to allocate time. And there is no easy money. There is no easy money at all in the stock market. The stock market and investment stock market mean allocating time, and there is no free lunch. Taking risk and making money. If you'd like to make good money, you have to allocate good time. In your beginning point, when you decide to start investing in stock market, whatever stock market, ETF will be very good choice. And start learning, start reading, start saying how things move, and you will learn. I think in your first year, it will be a very good option to start by the ETFs. Mr. Samir, should we continue on other questions, or?
I think that's, we are 4 p.m. now, which we exceeded the time by 1 p.m. I would highly appreciate, Dr. Muhammad, that you gave us this precious time.
Thank you.
I can find also in the questions and in the chats, so many people of the attendees are thanking you very much. And they said that it was very knowledgeable and informative session, as usual. This is something that we are used to when we have lectures by your good self. Thank you very much for Dr. Muhammad. Thank you very much for everyone attended. If you want the presentation or the slides in PDF, please send me email. Whoever wants the slides, send me an email to the email that you received, or reply to the email that you received from the invitation, and I will share the PDF. For the recorded session, we are now having a library for for our lectures, and once it is ready, we'll put it, upload it on the YouTube, and we'll announce on our website, and then I can share the link with all of you, inshallah. Thank you very much again for Dr. Muhammad, for yourselves, and see you, inshallah, will be joining us on the 10th of May with Dr. Bana Abu Zayed on the fundamental analysis session. Thank you, and see you, and Assalamu alaikum wa rahmatullahi wa barakatuh.